Hello and welcome. You're watching KYC. I'm Harsh Saita. With me is Mahima Vajrajani, and no bets, frankly. It's going to be an FMCG consumption space that we're going to talk about. Yes. But you know what you want to know is whether alcohol and the beverage industry is going to see a strong tailwind. Premiumization is the middle word of that theme which is playing out, and which will likely mean that margins will likely have an upside surprise. I can't say will have an upside surprise, and will likely have an upside surprise, and therefore will be interesting to understand what Som Distilleries makes of all of this that's playing out, because the balance sheet doesn't look under pressure at all. There's a very strong tailwind in terms of growth, and one of those geographies that they are really targeting and going to target strongly is going to be UP. And what impact does UP have on their top line is what I'd want to first understand. And I'm sure that they're not going to give me a real answer to this question. So what I'm going to also do is going to ask them, and I hope they're not listening, but I'm going to ask them what mix is UP going to command, because they've given an FY27 guidance of 2,000 crore in terms of sales. So what is that mix which UP is going to command? Because they have select states, Mahima, in which they have very strong presence, and then thereafter they don't have much presence elsewhere. Okay. Globally also no real presence, and therefore that also is a risk that one needs to be mindful of when they are investing in something like a Som. So that's a risk, but this huge foray and the fact that there's a large tailwind in this space is obviously the big benefit. They're doing 600 crore of capex, and 350 crore of that is expected by end of FY26. So what is going to be the debt component? They've currently iterated and reiterated. No debt, no fresh equity. But of course, we will ask them one more time. We'll quiz them on that, because it's a large capex which they are undertaking. For a sub 3,000 crore company, that's certainly large. Now, new launches, and that's what they're focusing on. And contribution of premium. Currently, premium doesn't have a very large contribution. It's maybe sub 10%, if I recall right.
Correct. That's probably one of the reasons as to why foraying into UP will be beneficial from them, because there's more concentration of tier 2, tier 3 cities which don't per se consume premium brands.
Correct. So what does new launches bring to the table? What's going to be the breakup in terms of the mix, and are margins incrementally much better in premium versus their traditional? Karnataka concerns, those were concerns, of course, which cropped up. Q4 cash flow to a certain extent was subdued on the back of that, but are they firmly behind is what I'd want to know. And now FY26 is their only tailwind coming in with regard to that. Risks from barley, glass, that's the only commodity exposure they actually have. Currently, there is no concern. In fact, last 2 to 3 years, it's been clean in terms of tailwind, no problem at all. Last piece is with regard to margins. They've guided for 12 to 13% margin, but could that surprise on the upside? Because if it does, you could see very strong accretion to profitability, which could re-rate or make a case for a re-rating on the counter. But I'm going to allow Mahima to take it away with regard to what the company does.
Right. So, as Harsh rightly mentioned, it's one of the companies that's present in the alcobev space and majorly has exposure to the beer space, and then IMFL, of course. That's your Indian manufactured foreign liquor. It was incorporated in 1993 and is based in Bhopal and is engaged in manufacturing and sale of beer and IMFL. It sells beer, whiskey and vodka per se, and the kind of portfolio that it has, this is its beer portfolio. Hunter, Blackford, Powercool, Woodpecker as well as Legend are the brands that it has under the beer portfolio. In the whiskey portfolio, it's got brands like Mahawat, this is the recent one, and a slightly premium side of whiskey that premium side of IMFL that they have, and of course whiskey. The other one is Blackford, Sunny, Gypsy and Fox, which are the others in the entire portfolio. Rum and vodka is a very small, very small portion of their portfolio, but they also have ready to drink and mixers in terms of cocktails in their portfolio as well. In terms of where the manufacturing facility stands, they've got 3 manufacturing facilities in India. The total capacity as of their latest presentation, well, this is the breakup in terms of the Hassan plant, the Odisha plant as well as the Bhopal plant. So when you try to sum this entire thing up, overall beer is 38.9 million capacity and IMFL is roughly 4 million cases in terms of where the capacity stands, and they're also expanding, as Harsh mentioned earlier, in the UP, and that allows them a capex of around 600 odd crores. In terms of the raw material exposures, again, as Harsh said, barley and glass are the 2 main raw materials for the counter, and the fluctuation in the prices is something that will impact their margins overall. And it's difficult, in this kind of cutthroat competition to pass on the kind of inflation that takes place in barley as well as glass as a raw material. Lastly, in terms of the breakup of overall sales, as you rightly, as I mentioned earlier, this is the second largest beer manufacturer in India. So beer is around 95.5% of their overall volumes, and 4.5% right now is IMFL. Beer was earlier higher as a percentage, but that's now come down to 95.5. So the other question here also is whether they're actually planning to, give more exposure going forward to the IMFL side of things or not. So that's with regards to where, the entire whole and soul of the company stands.
Well, yes, one piece, Mahima, is the fact that 99% of their sales are focused on Madhya Pradesh, Karnataka,
Correct.
Odisha and Jharkhand,
Yes.
just 4 states. And therefore, UP could be that huge foray, just given the population size scale that UP commands. Largely, margins are stable across geographies. So, a hint into what UP will command on an existing mix, if the mix does not change substantially, you will likely see margins remain as is. Taxation, MRP caps can impact profitability state-wise, but broadly, that's the theme. So that just kind of caps off whatever Mahima, of course, had to start it off with. Let me start off also with now the metrics, and the metrics that we look at is income statement, balance sheet, cash flow, return ratios, shareholding, street cred, there's no street coverage, there's outlook, and thereafter there's valuations. And I'll allow Mahima to start with the income statement.
Right. So, I'll start with the income statement first from a broader perspective from FY22 to FY25, and then see how they've done this quarter. In terms of where the overall revenue stands, the 3-year CAGR has been a whooping 58%. EBITDA CAGR has been around 108%, and the company has gone from a loss of 10 crores in FY22 to profits of around 100 plus crores in FY25. Margins have also significantly improved from that 5% mark in FY22, but has remained in that range of 12 to 13% mark in the past 2 odd years. So that's with regards to where margin trajectory is into picture. So the question really here is that whether in FY26 they'll be able to do better margins, because the guided range is slightly higher, and they've always done at the lower end of what they've guided for. That's with regards to where the overall income statement is concerned. But in terms of where the Q1 performance stands, Q1 FY26, overall revenue saw growth of around 3% YOY basis, but good growth sequentially. EBITDA saw a growth of 9%, and majorly this particular quarter beer companies were impacted because of short summers, so that's also an important aspect to keep in mind. And overall net profit saw a growth of around 2 odd %, but the numbers did not seem that bad, considering the other player in the industry also did post similar set of earnings. So overall this quarter is not a festive season, plus early monsoons has impacted beer sales overall, and that's with regards to where Q1 stands. But the overall picture in terms of where the CAGR is concerned, when it comes to their revenue, their EBITDA as well as their PAT growth, it's been a good considerable growth, and that's why we've given it a thumbs up when it comes to the income statement.
Perfect. Yes, the 3-year growth, very, very impressive, no doubt about that. Let me now talk about the balance sheet. And when you're looking at the equity shareholders funds overall, which kind of gets you that book value of 747 crore. It's currently trading at roughly 4 times book. And the borrowing number also doesn't look too substantial at 171 crore. In fact, the borrowing number has come down and has come down materially. The borrowing number in FY20 was around 200 to 220 odd crore, rose in FY23 as well, and thereafter has fallen down, and from 240 crore in FY23, the borrowing number currently sits at 170 crore. So you've seen elevated borrowings which have now been quickly repaid, which is a thumbs up, which is a positive. Plus you're seeing very strong tailwind with regard to the numbers itself. So the EBITDA is now well in line to cover that borrowing number. So no concern there. Cash balance of 20 crore is all right. And broadly, we've given this a thumbs up because the balance sheet clearly improving and the top line growing very, very quickly and without taking on considerable leverage. So all of those are positives. Mahima, cash flow.
Right. So, when we take a look at the entire cash flow picture, the cash flow from operations, as compared to FY24 and FY25, it has come down. But with regards to where the overall growth is concerned, it's been a considerable growth. But the ratio that we always talk about here is the cash flow to EBITDA part, the operating cash flow to EBITDA part, and that's been declining, which is why we've taken a conservative approach here and given it a neutral rating. The net cash flow position, however, has improved from a 3 crore in FY23 to a 6.57 crore in FY25. But considering everything in place, the kind of capex that they're doing right now that's in place, plus considering how they'll be, funding that capex, we'll have to see as to how that plays out on the cash flow side of things, and that's why we've given it a neutral rating as of now.
How that plays on cash flow, how that plays on return ratios.
Return ratios,
and
correct.
Let's talk about that. And return ratios have improved significantly. They had a couple of tough years post-COVID. FY20 was okay, but FY21 was a year where there was considerable pain, FY22 as well. But FY23, 24, 25, we've seen mid to high teens in terms of ROCs, which is very healthy. So really, we'll give this one a thumbs up as well. Hopefully, it's sustainable. That's really the question one will have to ask management as well. But broadly, no concerns at all. 16 to 18% is quite a healthy ROC. Shareholding pattern, Mahima.
Right. So, if we take a look at the shareholding pattern, the promoters have been slightly increasing their stake. Of course, not a 50% plus stake here when promoters are concerned, but from a 33% to a 38, almost 39% in March 25. FIs hardly hold any stake in the company. It's been in that 1% mark in the past 3 odd years. DI is also, not a lot of interest there as well, but public shareholding is very large here. So it's come down from that 66% mark to a 59% mark, but it's a very high retail investor stock. But just because there is less FI interest here and the promoter holding is not beyond that 50% mark and plus a very high retail invest, we've just taken a conservative approach here and given it a neutral rating.
Perfect. So street cred, let's quickly move on. 1 month, the stock price is down 4%, but otherwise, 6 months up 37, year to date up 35, 1 year 36% up. So clearly doing very well for investors. The stock is a 16 bagger over the last 5 years. So it's done very, very, very well for the retail investor. So we've given this a thumbs up, no concerns there. Outlook, Mahima.
Right. So, FY26, the revenue growth guidance is anywhere between 20 to 22%. Management expects a volume growth of around 18 odd %. The growth will be driven by expanded capacity is what they're saying. They've expected to, maintain the EBITDA margins at that 12.5% mark. They've gone out and said that no QIP or equity raise is something that is on the cards. And management has repeatedly emphasized that, the funding of capex will not be done via any equity raise. So this is with regards to where the overall outlook for FY26 is concerned.
Okay, I'll talk about valuations. 20% growth, 12.5% margin odd is what I have assumed as part of my valuation thesis. The top line therefore goes as is on your screen. FY27, I've assumed a 16% growth only from a perspective that management themselves are guided for a 2,000 crore aspiration in terms of revenue. Could there be an upside? Well, if new capacity were to come through, certainly could be. And therefore, you're seeing the kind of valuations that you are on your screen, 21 times price to earnings 1 year forward or maybe 6 months forward now. And then thereafter, 17.5 times. If I look at it, the FY27 numbers broadly, of course, not factoring in incremental depreciation, if that were to be booked broadly, this is the number that we're arriving at. And those are some of the assumptions on your screen. And mind you, the 5-year average price to earnings multiple that this one has clocked is around 25 times. So already trading at a discount. Despite that, we've been slightly more conservative on this count, given this one a neutral, because you have other players as well, which are trading maybe not at similar valuations, but have potential to obviously compete. And therefore, you want to wait and watch whether those growth forays actually play out or not. And therefore, let's stack up all of the rating parameters that there are, and that gives you no thumbs down across all the parameters, and it gives you a very healthy 6.5 out of 8 on our KYC rating for a Som Distilleries. That is obviously impressive. It's been that kind of company that we've seen today. Let me bring in JK Arora, who's the managing director of Som Distilleries, and to talk to us about, of course, what the future holds. Mr. Arora, great having you. Good morning. I'm Harsh, with me Mahima. Let me first start off by asking you, what is it that UP holds for you as an opportunity? Your expected growth is going to be 20% FY26, maybe 16 odd percent FY27. How much of that growth is going to come from UP? What's the mix looking like?
You see, UP is the most progressive state from my point of view in the country. The way the administration, the way the government is functioning is amazing. My experience with the UP government, if I tell you, is really a very, very comfortable, very, very supportive atmosphere. That's one, to put up the unit there. But this is not the sufficient. UP is you appreciate it, is the 6th largest country in the world, alone UP. And if you see their revenue, in just 5 years of time, from 10,000 crores to they have reached to 40,000 crores. So they are not believing in, any kind of, dakoslabaji, that this liquor is this, liquor is that, and this. And they simply say, if somebody wants to drink, we are nobody to decide what you want to drink, what you want to eat, what you want to wear. It's not our job. So if you are drinking, our job is to tax on the liquor, and we have to have the revenue. So this thing, if the consumer is available on the metro station, you put up a shop on the metro station. It's as simple as that. So this attitude brings in a lot of revenue growth, and market has become really, really big. So any liquor company in India, I would say, cannot do without UP. UP is one of the biggest market, most progressive market in these things. So UP, of course, UP, the players are already established there. It may take little time for us to penetrate the market, but since we are already there, and our acceptance of the brand is very, very good there. Right. So we hope that UP will be going to add a lot of value to us.
Got it. Mr. Arora, just want to try to understand. You've said that you'll do that 2,000 crore by the end of FY27 in terms of top line. How much of that are you expecting from UP in the early stages? And let's say going forward, 3 or 4 years down the line, what will the sales mix look like from UP versus other states?
UP, you see, we are expecting in first financial year, which is going to be the coming financial year. We are hoping to commence the production in the month of maybe January this year. So settling down, for all practical purposes, you take the next financial year. So we are hoping to add at least minimum 300 to 400 crores in the first year, and 500 to 600 crores in the second year from UP.
That is large. Do you believe that you can exceed that 2,000 crore growth top line guidance by FY27?
You see, we have always been quoting a conservative figure. If you see our past interviews, whenever we have quoted some figure, so we have already surpassed that figure. We have already always done better than what we have quoted. So this is our little conservative estimate. But as of now, we want to stick to that our that estimate. But I am quite hopeful. This thing, but the UP will take 2 to 3 years to be in the full potential, to exploit full potential from this thing. But UP is going to be definitely one of the most profitable and most progressive market for us. That I am sure.
Sarah, then I want to understand that how does your mix change in terms of premium versus your popular segment? Because the trend right now in the Alcobev space is that premium products are picking up and they are aiding the margins as well. So do you think that the premium contribution will go up? If yes, what will the mix be like? And then how will the margins going forward look like, let's say 3 years down the line?
You see, you have put in a very, very relevant question. This is the most burning topic as of now, this thing. You see, when I started career, on that time, this liquor is called Indian-made foreign liquor. Means the liquor, which is a foreign drink, made in India. That's why the name terminology is Indian-made foreign liquor. So that time, putting any Indian name was a stupidity. I recall when I started career in '87, we put up a new our first brand, Sunny Whiskey, and our competitor has put in a brand name Sholay. On that time, Sholay movie was on a very this thing. So that was a matter of you see laughing stock in the market. Okay, how you can put up an Indian name, but now you see the whole chemistry got changed. Now Indian name is being accepted worldwide, not only in India. So this thing is now altogether. So all premiumization is being happening on the name of the Indian names. We have recently launched a whiskey in Madhya Pradesh called name Mahavat. It's a beautiful packaging, beautiful product. So, and we are next week we are launching in Delhi also. It's a premium product. This thing. So that's it. And hopefully in next 2 months we are launching a single malt whiskey. That's name is Bhimbetka. That Bhimbetka is a place which has got a 10,000 old civilization, which is a wall paintings exist there. Bhimbetka is a tourist place in Madhya Pradesh.
Right.
So that's what it is. So we are on to premiumization on the IMFL.
Right.
You see, we are the only company who are available in beer and liquor both.
Understood.
You see, last three years, there was a huge growth in the beer. So we have tapped that potential.
Right.
Now, since looking to that potential, all governments have started putting the lot of taxes. So beer growth is now a little slow. So we are on to now IMFL, which is doing full well. So we are the only company which is playing in both liquor and beer.
Understood.
So that is the advantage with us. Yes.
Understood. So sorry for interjecting, but we just have a couple of minutes left with you. So I want to make the most of that time. In terms of the mix itself, currently you're sub 10% on Indian-made foreign liquor. Where does that go to when you do 2,000 crore of top line in FY27? Give us that number broadly. I understand you may not have a hard number there.
20%.
Excellent.
Yes.
Excellent. And so therefore, what does that do to your margins? Because tough to believe that margins will remain 12 to 13%.
The margins in liquor is always better than beer.
Yes.
So there is no doubt about it. So margins are going to be better. It's no way going to reduce. So
how much better? So would you inch towards 15%?
Not exactly 15%,
okay.
but it is definitely better. If you see this quarter, our margins are better than the previous quarter.
Yes.
In our last quarter, March quarter it's about 23 crores profit. This is more than 40 crores profit.
Got it.
So this thing it is showing this thing. Our IMFL volume in the last quarter is IMFL sale is just double. what we have sold in the same quarter last year, this year, this in the same quarter, IMFL is the double.
Understood.
So you can clearly feel where the focus is now.
Understood. Thank you so much, sir, for coming and speaking with us. That was
Thank you.
very, very insightful. Viewers, I believe we've got enough on our plate in terms of the guidance that Mr. Arora has given. Very clean, very clear. 400 crore in terms of the sales from UP in FY27. 400 crore in terms of IMFL, which will be 20% immediately off the bat by FY27 itself. And therefore, margins likely on their way up. You might want to tweak those valuation numbers a little bit. Completely out of time on this edition of KYC. From Mahima, myself, everyone who puts the show together, thanks so much for watching.